Started. Welcome everyone and thanks for joining our Take Flight webinar series. Today's topic is half year financial check-in and are you on track? Today's session will be hosted by Senior Relationship Manager, Retirement Relationship Manager, Jessica Jackson. And my name's Cody Genowan. I will be your host and today's session will be moderated by Jill Larson. Before we get started, a few housekeeping items. You are joining on mute. If you do have any questions throughout the webinar, please go ahead and submit them through the Q&A section, which you can access by selecting the three dots at the bottom of your screen. And then questions will be answered following the presentation. If you are new to WebEx, the first example shows how you can change your layout by clicking on the icon circled. And then audio changes is the second example. So the arrow right next to the mute button is where you can change the audio settings. This webinar is being recorded and can be accessed beginning tomorrow on our Take Flight Financial Wellness Hub, located at alaris.com/takeflight. There is a link at the bottom of the page to view our previous webinars, and you'll also be able to see there are several financial calculators that are available to you. Following today's session, you will be prompted to take a survey providing your feedback. We really appreciate if you take the time to complete this survey as it helps us with our future webinars. So today's agenda covers a mid-year plan review, what it should include, making adjustments to your financial plan, refreshing on the goals, and how to best execute a strong financial finish. I will now hand it over to Jessica.
All right, so thank you, Cody. So when we think about a mid-year financial review, really to set up that context, we really, starting off, we need to know what our purpose and value of a mid-year financial check-in entails, right? So first is providing increased financial awareness. So a mid-year review highlights our savings, our spending, our debt, and investments that helps to identify our successes that we've had in the year so far and areas where we may need adjustment, right? Because that's going to happen. That's life, right? All the purpose, all the more reason for that purpose of a mid-year review. So it also allows us to be adaptable to life changes. So it allows us to recalibrate the financial plan to reflect changes like job transitions or unexpected expenses. Because again, it's going to happen, that being life. And then lastly, that purpose and value of a mid-year financial check-in being it restores that motivation for us, right? And our own focus. It helps us to reconnect with our own financial goals, helps us to renew our own clarity, provides better momentum for us to make better decisions in the year's second half. So when you think about the purpose and the value of that mid-year financial review, where do you start? Well, here are some key questions to really help guide you to determining, an honest financial review and an honest conversation with yourself. That first question being, am I tracking my financial goals? It's an opportunity here to assess that progress towards your savings, debt repayment, and then any investment goals that you have for yourself by comparing your year-to-date results with your plans for the end of the year and as you move through the rest of the year. Number two, am I really truly analyzing my spending behavior? So here's an opportunity to think about reviewing your bank and credit card statements to help identify any potential spending patterns and also help to distinguish valuable from any habitual, unexpected, unintended, potentially expenses. Next would be, am I adapting to life changes? Here's an opportunity to think about, evaluate how changes in, potentially changes in income or priorities or obligations can affect your financial plan and then make those necessary adjustments. That fourth question is, am I preparing for uncertainty? Because again, it's going to happen, that being life. So think about your emergency fund in particular. Ensure those emergency funds and insurance coverage are adequate to handle those unexpected expenses and risks. So we've thought through these questions, right, to really set the stage, really set the context for us as we put together that mid-year review. So here's where we're going to start to really think about how are we going to compare those plan versus actual what we've actually experienced, right, with our financial plan and financial performance. Again, plan but pivot, so key, right? Hence the topic of this conversation today, mid-year. So first of all, think about that budget versus your actual savings. So review your savings goals against those actual results to understand those changes in your income sources and then also your savings habits. Second, expense categorization. So what this means is analyze potential fixed, variable, and also those discretionary expenses to help identify any spending patterns and even possible inflation effects as those prices have changed too throughout the year in various areas of our life, those expense categories. And lastly, debt and investment review. So this entails evaluating your debt repayment progress and also potential investment performance if you are invested in the market in various sources, such as your retirement plan, in the context of those specific market conditions and priorities.
So Jessica, what are some changes that could impact a financial plan when you check back at mid-year?
Yeah, so one of the main purposes, right, of that mid-year financial review is to evaluate those shifts and changes. Because again, I've mentioned it several times already, it's going to happen. And we need to be mindful of those. So first one would be identify unexpected expenses. So really look back to the past 6 months worth of those expenses to help recognize patterns in unexpected and one-time expenses for better financial planning. Think about your emergency fund assessment. So here's an opportunity where evaluate, does that emergency fund, cover, we're going to recommend, 3 to 6 months of essentials and then rebuild it if recent costs have potentially depleted it. We're going to distinguish emergencies from discretionary spending. So separate true, emergencies from planned discretionary expenses like vacations, for example, to manage finances. And then also structured financial planning. So think about transforming those unexpected expenses that we mentioned already into manageable expenses where we're going to plan and build to avoid potential, relying on credit cards, for example. So next here, we've accounted for potential income changes, financial shifts, unexpected expenses. So now we're going to think about reallocating our budget to reflect, potential new realities that we've experienced. So first being, we're going to adapt to any potential financial changes. So how are we going to do that? Well, think about adjusting your budget mid-year to reflect those changes in income and those unexpected expenses, realistically. That's a key word, realistically. Second, prioritize those spending categories. So rank your spending based on really true necessity and value here to fund things like essential goals that you've made, for yourself, such as potential housing goals or debt repayments as well. Also think about using automation for consistency. Think about automating potential transfers to savings accounts or debt payments to help maintain, your overall budget discipline despite those changes that you've experienced. And then lastly, that ongoing budget review being very, very important. So regularly review and refine that budget to help ensure it remains, overall realistic and effective for your goals.
Yeah, so if there are some of those adjustments needed, what are some steps we can take to help make those adjustments?
Yeah, so we're going to dive into that here a little bit further. So, here's an opportunity, first, think about updating and refining those goals mid-year, right? So number one, evaluate and review that goal. Because first of all, if we don't know if it's not working, right, what's the point, right? So we need to know, is it working, is it not working? So evaluate that goal or goals if you have more than one for that true achievability, and then adjust your timeline if necessary, right? To help maintain your progress. Set a specific target. This is where we're going to really apply that work. Um, Replace potential vague goals. Maybe you had a vague goal to really set the stage for yourself, and now you've refined it a little bit more as you've went through the year. So replace that potential vague goal with something that's more measurable. Put that target in place for yourself for better tracking and accountability. And then, lastly, focus on those top priorities. So concentrate at this point, right, on 2 or 3 even key priorities and goals to really optimize those resources that you have and then increase those chances of success. So again, we've refined those goals at this point. So how do we really move forward and make those smart budget adjustments to help us achieve those goals? So we have some suggestions here, and that first one being intentional spending. Evaluate and try to help identify now at this point some low value expenses. For example, like we think of those as potential unused subscriptions to resources, right? Um, Think about at this point, structured spending controls. So what this means is suggestion of some weekly spending check-ins and potential category limits that to help you prevent overspending and then overall maintain budget discipline. And lastly, automated savings and payments. So great tools out there to think about incorporating into your own plan to overall help reduce that temptation in these various categories to help build consistent financial habits. So some specific ways, at this point to strengthen our own savings, debt, and investment strategies is first enhancing our savings contribution. So at this point, really think about reviewing and even potentially increasing your own savings contributions. And I mentioned that earlier related to the emergency savings account. But overall, to help define that goal and achieve of accelerating your own financial progress without straining your cash flow. And again, this might include, regular savings account. It might include contributions to your retirement plan, for example. So efficient debt management. So here's where you're going to want to think about again. Prioritize at this point paying your high interest debt off first, and then consider even two, potentially refinancing or consolidating debt at this point to help improve manageability, as that may be an option and a tool in your toolbox as well. And then lastly, thinking about investment alignment and rebalancing. So what this entails is regularly reviewing and potentially rebalancing investments in various investment accounts or again, your retirement plan to help maintain alignment with your long-term goals and your own risk tolerance, that meaning how comfortable are you with risk and volatility with your own within your investment portfolio.
Yeah, so can you talk about, the best ways to accomplish the goals we set for the second half of the year, making some of those changes and adapting to what has happened throughout the year?
You bet. So the previous slides and material, right, the whole purpose was to set that context for a mid-year financial review, adjust for changes, reevaluate those goals and objectives. And now at this point, right, we recalibrate. We recalibrate based on the work that we've done and the progress that we've identified and that we want to work on. So how are we going to do that? How are we going to really define that clear action plan for that quarter 3 and quarter 4? And so that first step being define those specific actions. So again, taking all that work that we've done, evaluating those various portions of our financial picture, right, is at this point identify 3 to 5 really, strong, impactful actions that have clear deadlines to help us ensure that we have focus for the remainder of the year. And also it helps to encourage urgency, right, as we continue throughout the year. So set manageable milestones. We want to break our yearly goals into monthly or even quarterly targets for overall easier progress tracking and motivation. And that's the key. It's motivation. It's very easy to become frustrated or complacent if we can't continue to monitor our progress. So that motivation being very, very key. And then lastly, document and review our plan. So, record your plan, write it down, whether it be paper, pencil, pen and pencil, or you type it out, whatever it may be. But there's tools, right? There's different apps or spreadsheets as it works for you to, again, write that down, evaluate to help review it regularly for to align to those specific goals that you've set for yourself. So, again, we set the plan at this point, and I mentioned prior, tracking that progress and to help maintain accountability at this point is so, so important. And, so one of those being regular progress reviews. So here's at that point where we recommend those monthly check-ins at this point to help monitor key financial metrics and address issues early, again, to help sustain your own momentum as you move throughout the rest of the year. Utilize technology if that would help. Again, not necessarily for everyone. Pen and paper or a Word document is just fine for some folks too. But keeping in mind that, especially in this day of AI, there's lots of tools out there technologically that can help us in this regard. So things like budgeting apps, automated reporting tools can help simplify tracking and overall achieve the goal of increasing our own financial visibility more efficiently as we visibly see that. That tracking progress, enhances accountability. So if we share goals, potentially with a trusted individual, whether that be a friend, a partner, spouse, an older child, whoever it may be, but share your goal with someone that you trust. This can help create and foster that momentum and help support us for our own financial discipline. Lastly, celebrate those milestones, and this is very, very important. Don't forget to recognize those small achievements, and what you might think is small is not necessarily small, right? We have to take those small steps to take those small steps versus giant leaps. And so recognize those small achievements because that truly will reinforce that positive behavior that you've already implemented and adopted to help maintain morale. So on that note, as I mentioned, think about that mindset and motivation for finishing the year strong, and emphasizing this here because it is so important. So embrace flexibility. Adopt that flexible mindset to handle unexpected events as they come. And we know those are going to come. Unexpected events, unexpected expenses. Because if we have that flexible mindset, it'll help us from losing confidence and building our own resilience as we continue through the year. Connect actions to purpose. So, here's an opportunity where think about, stay motivated by linking these daily financial decisions that we experience to those meaningful long-term goals and outcomes I mentioned already. As we've done the work prior slides, and then recommending 2 to 3 top goals. Link those financial decisions to those top goals that you've set for yourself. And then again, lastly, to emphasize once again, celebrate the progress that you've achieved. Recognize and celebrate improvements that you've made, and to overall build that momentum and reinforce those positive financial habits.
Thank you, Jessica. A lot of great information. I know for me, talking about not being vague, having those goals we can actually measure, and then celebrating those milestones as well. I know personally I don't do a great job of, setting those more short term to then be able to celebrate in that success. So that was a big takeaway for myself. Jill, do we have any questions in the Q&A?
We have, yes. One came in. Let me see. Are there any free online budgeting tools that you can suggest?
Yes, there is a ton, right? So, and they're continuing to increase the financial technology world and the use of AI. So, right off the top of my head, and the ones that I'm familiar with, and of course, I'm talking with retirement plan participants with as well. So, for example, Rocket Money, there's a free version for that as far as an online budgeting tool. There's Wallet Money, one called Good Budget. There's actually a free tier involved with that. That specific app has like an envelope style budgeting option, really hands-on. And in this case, you can actually manually allocate money to categories like digital envelopes, which is really super helpful, again, for those folks that are more keen to the digital options, right? Every dollar, again, a free version there. This is going to be best for, things like the concept of zero-based budgeting, where you assign really every dollar a category. Every dollar goes somewhere. Every dollar has a job. So, and this is really helpful because there's customizable categories, and also spendable tracking too. And last one you're thinking about would be one called Pocket Guard. Again, there's a free tier as well. And this is really going to be best for, again, simple, how much can I spend tracking? And sometimes, right, we need to start there. We need to just know how much can I spend, right? And then we start from there, building that plan. These features involved with this app in particular, um, show, really at the end of the day, safe to spend amount on things like, after bills, savings, and things like that. Really giving that person that end dollar. So,
yeah, and
lots of options.
Pen and paper sometimes works just as well.
Yes, absolutely, absolutely.
One more. Is there a place that I can easily find recurring subscription charges to my bank account or credit card?
That is a really, really good question. And even something beginning of the year I took a look at for myself, right? just these recurring subscriptions, because they really have the ability to creep up and we forget about them, right? Out of sight, out of mind, like a lot of things. So, first of all, I'm going to recommend for this question is check with your bank or your credit card app and the website, because many financial institutions do have options where they make this relatively more easy than it was before. I should say that than it was before. So look for sections in these categories such as like recurring payments, subscriptions, auto payments, managed bills. That's typically where we're going to see those on those financial institutions' website and app. So for example, I know a couple of them, for example, Chase, on their dashboard, it says manage subscriptions right there. Easy peasy. There's an option right there. Amex, they have a recurring charges tracker in particular. I know Capital One, which is really, popular and really utilized, they show merchant subscriptions in something called a transaction insight. So again, just depending on the vendor, right? There's going to be different options, but those are, 3 right off the bat, directly from those institutions, and that's going to be your most accurate and safest place, directly tied to the account. But of course, there's some manual methods too, instead of just going directly to the site. So if your bank, doesn't label specifically those categories, you could manually do it. And so to do that, you could download, for example, 3 to 6 months of expenses. What you're going to want to do here is look for the same merchant. It's going to be, that same dollar amount, right? Because remembering it's that recurring charge. And then, of course, it's charged every month or maybe even year. So don't forget about the year. Sometimes those can really sneak up on you because you're not expecting those. And, for example, things like common subscriptions, of course, Netflix, Spotify, Apple, Amazon, Hulu, Disney Plus, things like that. Fitness apps, software, cloud storage, insurance, memberships. You're probably going to be surprised at the number of recurring subscriptions that you have. So again, great question to review it. And then lastly, of course, going back to the budgeting app question, there's going to be free budgeting tools out there that can help detect those subscriptions. And so many tools do automatically, I know, scan for recurring charges. Again, top options that come to mind would be like Rocket Money, very strong subscription tracking with this option. Another one, Power Personal Dashboard, Personal Capital, if you will, shows direct recurring expenses. There's one called Y and AB. That is a trial only, not fully free, but it is very useful for the short term. And of course, you may find it useful for the long term when I'm paying for it. And then I mentioned earlier, Pocket Guard. They have that basic free version to help with recurring bills. So options out there all come down to what you're most comfortable with. And again, may just be start with downloading a statement and going one by one and starting there. So.
All right. Well, that's great information. We got a couple more questions that came in, and these might be more advisor leaning, but I'm going to toss them your way. I think they're really good questions. The first one, wondering if this is maybe in the context of the emergency savings, but the question is with the stock market that is at historically high trading values and earnings per share metrics, is there a reasonable case to be made for profit taking by selling the stock and putting the money into a safer money market type fund?
Great question. And this is definitely going to be dependent on where this individual is in life, right? So for the average investor saving for the long term, when we have those high, again, high earnings per share, the stock market doing well, we've got earnings, things are looking great, right? But for that long-term investor, really, the answer is most of the time it's going to be business as usual and leave it as it is, right? For that long-term investment strategy. However, now, if a person is nearing retirement, again, this is where it can get a little gray because nearing retirement can be very different for some people, right? But as folks near retirement, where we have to start being mindful of preserving those assets, right? Because the younger we are, the more aggressive our account may potentially be, right? We have time to weather those losses that we may potentially experience. We have time to grow those balances, right? And over time, it's proven that those more aggressive portfolios, we see a higher return over time. Just market has proven that. So overall, to answer that question, should a person, take those gains, if you will, with potentially thinking we've had high returns, right? And may the market potentially take that downturn. For the long-term investor, likely not. The answer is going to be, continue to invest accordingly to your goals and objectives. If you're getting closer to retirement is where that conversation is going to become much more important on what that looks like for the long-term strategy as someone nears retirement and needs to preserve those assets.
Perfect. Perfect. Thank you. And just one more.
Yep.
At what point does it make sense? We actually, I think, had a take flight last year about this. So you might need to go back into the recordings and listen to this one. But at what point does it make sense to refi a mortgage? Looking at current mortgage environment with points, fees, rates, etc. And how long of a payback does it make sense?
That's a really good question. And actually, thinking of our role, right? Speaking with retirement plan participants in particular, where we're talking about that overall budget and kind of, putting dollars towards the retirement plan or a savings account or paying off debt or refinancing a mortgage, right? All part of that financial picture. And so, when does it make sense? Well, this is going to be dependent on that long-term goal and what we have as far as, how long are we going to plan to be in that home? You may have heard that term, oh gosh, what is it called? It's bury the house, date the rate, right? And and for some folks that holds true, right? Especially where we're at in this interest rate environment. We're certainly not, in the 2% interest rates, and a lot of people are holding on to homes right now. They're staying in homes because those rates when they purchased those homes were so low. And then the question comes into, gosh, do we purchase this home now? Do we refinance our mortgage? So it's a tough question to directly answer because it really is dependent on the context of an individual person and where they are at within their financial life stage, and what that rate is. So rates have, what we know is rates were not where they were at before, right? Several years ago. They're not where we were, a year ago. We've made some improvement, right? But we are expecting those to potentially decrease. But we're actually looking at potentially, start of next year rate hike. So in this year specifically, the Federal Reserve was looking at a couple of rate reductions, but that has changed now. So again, I'm going to reference this question of, speak with your specific financial advisor on does it make sense for you. especially if you're going to be in this home long term. That's the key too, is longevity and how long you'd be in the home.
Good answer. And that's it. No other questions have come in. So appreciate
All
it.
right. Yeah, thank you everyone for joining. We look forward to seeing you in future webinars.
Thank you. Mhm.